In this video, I want to talk a little bit more about entry triggers and just provide a few additional insights and thoughts on the matter. And when we talk about entry triggers, we can really use any chart-based event as a potential entry trigger. First of all, we can start with a classic breakout or pullback, which I think most trading strategies will fit under. So breakouts, we can use breakouts from patterns. However, this is not as black and white as it may seem. We could have a pattern breakout, but then other traders are applying filters. For example, they don't only want to see a neckline of a head and shoulders get broken by a candle, but they're very specific about the distance, how the break has to happen. They maybe prefer or require to have relatively large candles. They maybe even have specific ratios for the distance of the pattern. So you can see, although we say we just have a regular breakout pattern, we could add other criteria on top of that. We could also have a breakout above or below a support level, through a trend line, through a round number, supply and demand area. And again, it's not as black and white as it may seem. We could layer other filters and criteria on top of that. We could have a breakout above a recent swing high or a swing low when we look at trend waves and how they form on our charts. We could have a breakout from any chart tool really, so we could use any moving average. We could trade a breakout through a Bollinger Band, a Donchian channel, a Keltner channel, a regular trendline channel. We could use a breakout through a pivot point as well. Then we could look at pullbacks, and we could have the market pulling back into a pattern. So this would be maybe similar to a retest approach. So we have our head and shoulders breakout, the market pulls away a little bit from the neckline, and then the trader is waiting for the market to pull back into the neckline. And again, we could have different rules for how the pullback should manifest. Are we placing our entry at the neckline when the market is touching the neckline? Do we wait for the market to fall back a little bit inside the pattern itself, which could be more of a stop run strategy? We can be very specific about this here as well. And also, how do we trade the pullback? Do we just wait for the market to hit the neckline, or do we wait for the market to pull back and show us some reaction? We could have a pullback back into a trend line, back into a support and resistance level that has been broken prior, into a round number, into a supply and demand zone. We could have a pullback into a previous swing high and low, so a previous high may become a low, a previous low may become a high when a trend unfolds as well. Or we could have a pullback into any chart pattern, moving averages, Bollinger Bands, anything really. And there are really no limitations when it comes to entry triggers. And you can be super creative, and there's also no right and wrong. The right and wrong is determined then by the results in your backtest. Or maybe not even right or wrong, but better or worse. You come up with a combination of entry triggers, you define the rules, then you apply it in a backtest, and the backtest will show you, is this making money or not? And then you can change it or start something new. So here are a few more lists of potential entry triggers. We could get into a trade as soon as a specific moving average cross. So we have 2 or 3 moving averages and we wait for a cross, and that is our signal. We can wait for the market to cross the moving averages and then get the price on one side of the moving average as well. We could do that also for the Ishimoku cloud. We wait for the market or the Ishimoku signal to give us a crossing signal. We could wait also for the separation of moving averages. Maybe the moving averages are coming together and then we wait for them to get further away, which is a momentum signal. Or we could get in as soon as moving averages touch. We could also have entry triggers around candlestick patterns itself. So whether we look at pin bars, engulfing, morning stars, evening stars, you name it, and then we can have different rules on the pattern itself. Some traders only get in right when you have a pin bar. Other traders say that they want to have a price event around the pin bar. So for example, you want to see that the market is breaking above a high, above a low, above the close, whatever it is. You have specific rules on the candle itself as well. And of course, as we can see later, we can have different combinations of tools. So we could say, okay, we want to have a pin bar that penetrates an outer Bollinger Band and then snaps back into the Bollinger Bands. We could do that for support resistance, for anything really. We could have an entry trigger based on any indicator event whether it's a divergence indicator, crossover signals, specific values, so stochastic going into 80, going into 20, coming out of 80, coming out of 20. We can have patterns on our indicators. You could draw a support resistance, a trend line on your stochastic, on your MACD, on your RSI, and wait for the pattern to be broken. Everything is really possible, and there are traders who do pretty much anything that you can think of. You could have a gap close strategy. You could even trade failed signals. A lot of traders trade failed pattern breakouts. So they wait for a market to break out of a range, and then they wait for the market to fall back into the range, which could be considered a fake out signal or a trap. We could have a potential entry trigger on a Fibonacci level when the market pulls back into a specific Fibonacci extension, into a specific Fibonacci retracement. You wait for that. We could have a signal on volume as well, volume peaks, volume declines. We could use our volume profile as we have seen, or as we will see. We could have a potential entry trigger if we trade news events, market correlations, and really no limits whatsoever. And also we could have entry triggers based on the overall chart context. So this could be also a filter layer that is commonly used for chart context. So for example, we could use our higher time frame context, sorry for the typo. So for example, we could have a filter for trend direction based on the higher time frame. We can look at highs and lows. We could look at the price in relation to moving averages, which is what a lot of professional traders are doing. They have maybe the 10 or 20 period moving average of the daily time frame. And if the price is above this moving average, they only look for longs. If it's below that, they only look for shorts. You could look for trend maturity as a filter. So you look for how long has the trend been going on, and that could be a criteria for whether you look for continuations in an early trend or reversals in a late trend. You could also look at, is the market in a pullback phase or in an impulsive phase? You could look for higher time frame price action. So you look for a pattern or a candlestick on a higher time frame and use that as a first filter. You could use higher time frame chart levels. So you could use the weekly pivot, the monthly pivot, a very big support and resistance level on the higher time frame, big supply and demand levels from the higher time frames. You could use time of day context. For example, many day traders only trade the session open or around the session open. Many traders also look for yesterday's high and low, yesterday's open, yesterday's close. They're also very important reference points. We could use volatility. So for example, we only look for narrow ranges, narrow Asian ranges, narrow London ranges, and you can use that as a filter as well. And of course, usually when traders design a trading strategy, as we will do also, if you have maybe watched the video, you will see that usually you combine an entry trigger. You don't only use a trend line, you don't only use a pin bar, you don't only use whatever it is, but generally you use multiple entry triggers. For example, you could have your higher time frame level, the higher time frame candle as your first filter. You could have a lower time frame pattern breakout, lower time frame divergence, or here, this is the higher time frame, the daily. We could have three signals here. The price is at a previous low, significant low here. The price is in a mature trend. The market has been going down for quite a while. We have deceleration candles here with the wicks already poking to the upside. So we have criteria on the higher time frame. Once they're present, we could go to the lower time frame. Here we look for patterns. In this case, we have a build-up. We have a head and shoulder pattern or inverse head and shoulder, with here the right shoulder being significantly higher than the head. We have a pretty decent resistance level that we could use. And then our final criteria could be we wait for a breakout. The breakout, we could say, should be much larger and should get far away from the neckline. We don't only want to see that the market is just barely creeping and crawling over the level, but we want to see a decent push. And that could be now our entry signal. And you can see now we have 5 entry criteria, or 4. We have our lower time frame momentum, we have the lower time frame pattern breakout, we have the higher time frame scenario as well. And that could be used as a trading strategy, or at least as a starting point. The point of this video is that there are really no limitations and you can be very creative. You could also look around. What I find very inspiring, or just to get an idea of what other traders are using, is read trading books, listen to trading podcasts. There are so many great podcasts out there where traders actually talk about their trading strategies. You have obviously hundreds and thousands of YouTube videos coming out every week, every month. You have trading books as well, the Market Wizards, They often even go pretty technical about their trading strategies. So there are so many examples, and you will see that traders use so many different variations and approaches. There's no right or wrong. It is just about what makes sense to you. You apply it in a backtest, you see if it works or not, and then you can go forward, change it, improve it. So I hope in this second entry trigger video about the entry parameters, I was able to give you a few maybe different insights, maybe look at the topic in a different light so that it clicks for you as well.